Good morning. It's good to see so many of you joining us to hear our analysis from the experts on a budget that had a few shocks and quite a few surprises. My name is Tim Stovold, one of the tax partners at Moore Kingston Smith. I'm sure most of you are familiar with who we are, as I can see lots of regular names on the attendee list. However, for those of you who don't know us so well, Moore Kingston Smith is a top 10 audit, tax and advisory firm working with businesses across all industries, non-profit organisations as well as private clients. We're also part of More Global, an international network with presence in over 100 countries. So yesterday we had the first budget from a new Labour government. The long period between the election and the budget allowed the rumours of what might happen to run wild, and many individuals and businesses accelerated decisions to make sure that actions they took were in a known tax regime rather than taking the risk of what the future might hold. Some of the more extreme fears proved unfounded, but the 40 billion of tax increases that the Chancellor had targeted needed to come from somewhere. So businesses and individuals are all contributing to a greater or lesser extent. As ever, the devil was in the details, so I'm delighted to be joined by my fellow tax colleagues, Nick Blundell, Roberts and Joseph Adunse. Nick is a specialist at all things relating to corporate and business taxes, and Claire and Joseph are two of our private client tax partners. My job's to chair the session today and also to muck in to cover the employment tax related issues. I'll also be keeping an eye on your questions as the panel run through the detail and picking out the most difficult ones to put to them. Please, can you put your questions in the Q&A? It just helps us keep track of the ones we've answered, the ones we haven't, and I'll try and weave those into the presentation as we go. So to get started, I'll set the scene and then we'll get into the details. So today we're going to cover a little bit of an overview of the context in which this budget was given. And then the key announcements across personal taxes, which is where most of the big announcements were made, corporate and business taxes, a bit around admin and HMRC powers, and then a little bit on indirect taxes. Questions, as I say, please ask them throughout, and we'll, as I say, I'll weave them in as we go. So the context of what we're doing here today. So we're in a rare period in history where Labour have got a significant majority at the beginning of their time in government, and at this time we always expect bold moves to be done because without a very significant rebellion, everything they want to do will be passed. And also, if they're going to do anything unpopular, any new government will always do it at the beginning of their 4-year period rather than at the end. So we knew this was going to be a painful one. Rachel Reeves, the first female chancellor to give a budget, was severely restricted in the manifesto. So there was a commitment not to raise basic, higher or additional rates of income tax, no increase to national insurance, although there was a bit of wriggle room there, as you'll hear, no increase to VAT, apart from the VAT on independent school fees. The corporation tax has been capped at 25%, giving us some stability in the corporate world. And then this wide but vague commitment not to increase taxes on working people. So what we heard in July, the sort of softening up, and I think there was a lot of preparation for the voting public and taxpayers that it was going to be really bad, was the 22 billion pound hole in public finances. And that really set the scene for some fairly significant tax increases. To raise that amount of tax requires very bold measures. 1% on the basic rate of income tax raises only 6 billion. So it would require, if they wanted to raise it with a simple income tax measure, it would require 4 or 5% to cover the 22 billion. We also had external parties making some pretty damning comments about the UK economy more generally. So UK's performance over the past 2 decades is hard to describe as anything other than a policy failure. So we're in the situation same as the US, a high tax burden, high levels of debt, and a strain on public services. The long period between the election and the budget did allow rampant speculation, as said here, and capital gains was the bulk of the discussion, but also inheritance tax and other areas were unprotected in the manifesto, so were thought to be targets for this budget, and that's exactly what happened. In the days leading up to the budget, we had the discussion of what working people were, and all manner of politicians being able to describe a working person and a fear that the top rates of tax may go up on earnings, or that investment income may be targeted. So, clarified on the days into the budget, and we now, of course, know the outcome. So with that as being the context in which we're operating in, I shall hand over, I think, Joseph, if we just click on to the next slide. I think Claire's going to get started on the personal tax measures. As I say, do ask your questions in the Q&A as we go, and I shall try to weave them into the presentation. If not, we'll follow up on them after today.
Thanks, Tim. So income tax, this was a promise delivered. So there have been no increases in income tax rates, and that's not only for working people, but for all individuals. So as Tim mentioned, there were some concerns that we could see a change in tax rates for investment income. That will not be the case. Similarly, national insurance for employees and the self-employed, those rates are not changing. So the current tax allowances and thresholds have been frozen since 2021 and will remain frozen until April 2028. And that's under a policy by the Conservative government, widely labelled as stealth tax, as the tax take rises as income rises. And I guess in what you could describe as perhaps the biggest giveaway in the budget is that the Chancellor announced that these thresholds for income tax and national insurance will be operated by inflation in April 2028. So good news, the end of that freeze will mean it's more money in people's pockets, but clearly that immediate relief will not be felt straight away. Now, the high income child benefit charge, controversial charge in terms of how it's levied. So currently parents pay this charge if they start earning over £60,000 a year. And once you earn £80,000 a year, that child benefit is lost entirely. So it does mean that if you have a family with two parents earning £60,000 a year, they keep all their child benefit. Whereas if you have a one parent working household earning £80,000 a year, that child benefit is lost. So quite unfair in terms of how it's levied. Now, the Conservative government did commit to launching a consultation on whether that charge should be based on household income. But unfortunately, Labour have decided not to go ahead with that, citing the cost of £1.4 billion being the barrier in doing so. So it is disappointing because it does leave families with only one earner or your single parent families facing that cliff edge of £60,000. The silver lining, I guess if you could call it that, is that the simplifications will be introduced in terms of paying the charge. So the government will allow employees to pay the charge through their tax code from April 2025 and will pre-populate self-assessment tax returns with that child benefit information to allow the payment, well, to ease the payment, should we say, of that charge. So unless you've been living under a rock for the last few months, you will know that capital gains tax rates, the increase in those were widely expected, but the increase perhaps wasn't as bad as many had feared. So the lower rate of capital gains tax, which applies to basic rate taxpayers, will increase from 10 to 18%. And the higher rate of capital gains tax, which applies to higher and additional rate taxpayers and trustees, will rise from 20 to 24%. So these rates are now aligned with the rates applying to disposals of residential property. Those rates are unchanged. So it will simplify matters now that we need to consider less rates when we're thinking about disposing of assets. So these new rates apply to transactions on or after budget day, so 30th of October 2024. So it will mean that there'll be different rates applying in this tax year. And as is usually the case when capital gains tax rates increase, we have seen specific anti-forestalling provisions, which means that for capital gains realised on disposals made under unconditional contracts, which were entered into before budget day, but which will be completed after, the new rates of CGT will apply to those disposals. Perhaps rather unexpectedly, we did also see a change in the capital gains tax rate applying for qualifying disposals of business asset disposal relief. So as it stands, disposals qualifying from that relief benefit from 10% tax rate up to a lifetime limit of 1 million. So that lifetime limit is not changing, but the capital gains tax rate will gradually align to the lower rate of capital gains tax, increasing to 14% from April 2025, then to 18% in April 2026. And the idea of the phasing in apparently is to demonstrate the government's commitment to a predictable tax system. So let's see how that plays out. So to the extent that you can, there will be opportunities to perhaps accelerate sales before the end of this tax year and next to benefit from those lower rates before the uplift. So in a similar lines, investors relief, which I can't say I've ever really come across in practice, which similar to business asset disposal relief, but is more aimed at investors who are not actively involved in the business. The lifetime limit for that relief is also going to be reduced to 1 million to match the business asset disposal relief lifetime limit, and that applies again from yesterday, the 30th of October. And all in all, these capital gains tax changes are estimated to generate around 9 billion over the next 5 years. So, I mean, let's see, because clearly those estimates can't necessarily account for behaviour, and we'll see whether or not these changes do impact taxpayers' behaviour. Next slide. Thank you.
So yeah, so the other thing that sort of was announced yesterday were sort of changes to carried interest and how that's taxed. So this wasn't a big surprise, because in the Labour sort of manifesto and campaign leading up to the election, it was emphasised that, you know, the perceived unfairness in how carried interest rewards are taxed was something that the Labour government would be sort of reviewing as soon as they came in, and true to their word, they have. So at the moment, there's 2 rates of capital gains tax that applies to carried interest, and that's 18% and 28%. So the change is going to happen from the 6th of April next year, is that there's going to be a single rate that applies to carried interest, and that will be an increase of 32%. So that rate is within sort of the range that people were expecting, but is a significant increase nonetheless. So it will be interesting to see kind of what the reaction to that is from people in the asset management industry, predominantly private equity people. And the other thing that was announced as well was that sort of there's going to be a wider reform of how carried interest is taxed generally. At the moment, carried interest is charged to capital gains tax, but there is a desire and an intention to move that from capital gains tax to income tax. So effectively, what that's going to mean is that it's going to be treated effectively as trade and income. So income derived by self-employed people, and with that, there will also be the addition of a charge to national insurance that applies to self-employed people, which is the Class 4 national insurance contributions. So that's going to be a significant change that's going to be coming in from April 2026. There is a measure of relief, if you like, in terms of the amount of carried interest that would be chargeable under that new regime from April 2026. There will effectively be a discount to the amount that would be subject to tax, and that will be achieved by applying a multiplier of 72.5%. And then that amount is then what's taxable at the marginal income tax rate of the person receiving carried interest. So at the moment, the sort of top rate of income tax that is expected to apply would be the sort of 45% rate. But obviously, we've got lower rates that apply depending on what your earnings are generally. Of course, people in the sort of industry affected typically would be around the 45% rate. So you'll end up effectively with an income tax rate that is equivalent to the capital gains tax rate that's going up to 32% from next year. There will also be additional consultation by the government, just to work out some detail about what people within the sort of private equity industry will qualify for this new regime. And that's because also in the lead up to the budget, there was some talk about there needing to be more skin in the game, in the sense of an increase potentially in how much people invest in these private equity funds before they become entitled to this sort of preferential rates of tax on the carried interest rewards they get from their involvement in the funds. So there's a bit of detail to come in terms of who will qualify and what level of investment they're going to have to make or increase to get the benefit of these rates, but that will all be consulted on over the next few months.
Joseph, there's just a question in which I think is a fair one, those not familiar with what carried interest is. So without dwelling any more time on it, because it will apply to a relatively small proportion, it's a way in which people who work in the private equity industry are paid, where they're actually paid a proportion of how much the assets they invest in are increase in value. So they've got an interest in those underlying values. There is a worry by government that this is just salary by another name, which is why they want it to stop being taxed as a capital gain and start to tax it at higher rates. We shall move on from that, but thank you for that question.
Yeah. So the next big change is not an unexpected change again, which was the abolition of the UK tax regime that applies to non-UK domiciled individuals, so-called non-DOMs. So you might remember that in the last budget of the previous government, there was an announcement that the regime was going to be abolished with effect from April next year. And the Labour government had, accepted that was what they were going to do, and they felt that the changes proposed by the previous government didn't go far enough. So there was an expectation that some of the detail in the abolition would be different under a Labour government, and that has transpired. But what hasn't changed is what the new regime is going to look like in terms of the length of time it will apply for those who qualify. So as expected, for the first 4 years, for somebody who's, for example, never lived in the UK, they will have a 4-year period under which they can get an exemption from UK tax on any of their foreign income and gains. And that is something that's quite different from what previously existed, because previously you could get up to 15 years. However, that required you to keep the foreign income and gains outside the UK. However, this new regime will not have that requirement, so you can get the exemption but still enjoy the money in the UK. So that's a significant change in terms of length of time this preferential regime is going to apply, but there's also a benefit in the sense that you can actually spend the money here, whereas previously you'd have to pay tax on it if you brought it here. The new regime is going to be based on tax residence. So we've had a statutory residence test since April 2013, and that is sort of well established now, and people can reasonably determine their tax resident position for a tax year. Whereas the previous regime was based on a concept of domicile, which is badly understood by many, because domicile is understood by some to relate to residence, whereas it's a different concept. It's sort of a common law concept that's related to where your permanent home is. So the sort of abolition of the relevance of domicile in the UK tax system is welcomed, just because it introduces a bit of simplification in terms of understanding who will be able to benefit from this new regime. So usually where there's these significant changes to pre-existing tax rules, there's often transitional rules introduced, and there will be a couple of transitional rules introduced with these changes, which will be a rebasing of the value of foreign assets for people who are at the moment able to be sort of taxed under remittance basis on the current non-DOM regime. So the dates that the government have picked for this rebasing is the 5th of April 2017. The previous government had said it would be 5th of April 2019, but I think the general consensus is that both dates are perhaps not as generous as they could have been, because, for example, there's been quite a lot of inflation over that period of time, and people might have been here for many years, and they might feel that they're going to have to pay tax on things they weren't expecting to pay. So there's a bit of an argument about whether or not the date is correct, but that's the date that's been chosen. So the benefit of that is, if you've owned an asset, for many years, you get to sort of keep some of the gain that's accrued over that period of ownership from being taxable after the 5th of April 2025 if you sell those assets. A feature of the previous or the current non-DOM regime is something called overseas workday relief, which essentially exempts a portion of employment income from UK tax if some of the work you do is outside the UK. So that is being retained in this new regime. And previously, it was announced to be a 3-year relief. However, yesterday, the government announced it would actually be increased to a 4-year relief. So that's a welcome extension. There are sort of commentators out there that still feel that the length of time isn't internationally competitive. And there's European countries, for example, that have much longer periods where there's an exemption from tax on such income. However, that's what the government have chosen. But it's kind of welcome to know that there will be a form of relief kept for people, for example, employers sort of, seconding employees to the UK.
There's a few questions, Joe. I'm just going to just interrupt you. There's a question around I don't know if you're going to move on to IHT and domicile, about whether under the UK-India tax treaty, that's been relied on for many years to overrule the domestic law of domicile. If domicile is no longer featuring in the UK tax law, what's the current view on how treaty-based planning will work?
Yeah, so there was a helpful sort of hidden in the detail announcement that the existing inheritance tax treaties the UK has with several countries will be maintained. And as part of that, the concept of domicile as a general concept remains under international law, and that will be retained for the purpose of those treaties. So while it won't be in UK domestic tax law, it will be retained for the purpose of the application of those inheritance tax treaties.
So from an inheritance tax point, certain territories, India being the one that comes up most often, still have very, very powerful planning opportunities. I've talked to my Indian clients and colleagues in India, and because we're currently trying to negotiate a trade agreement with India, the likelihood of us trying to rip up the inheritance tax treaty is pretty low right now.
Yeah, no, definitely. So in terms of the second transitional rule that has been announced or had previously been announced, it's the so-called temporary repatriation facility, which essentially means that where people have historically or currently for the tax year we're in now claimed to be taxed on a remittance basis and have got sort of, income and gains being kept overseas, they will be able to bring the sort of untaxed foreign income gains to the UK from the 6th of April next year and pay a lower tax rate on that remittance than would currently apply. So at the moment, if you had unremitted foreign income and you remitted it in a later year, you'd have to pay tax of up to 45% on that income. And for gains, you'd have to pay up to 20% for most gains that have been realised. So under this temporary repatriation facility, which will start from the 6th of April next year and will run for 3 years, there will be a lower rate of tax that will be applied to any remittances of those previously untaxed foreign income gains of 12% for the first 2 years. And that 12% rate will apply to both income and gains. And for the 3rd year, where that temporary repatriation facility applies, it will be charged at a rate of 15%. So there's a change there from what the Conservative government had announced, because it was initially going to be 2 years, but now it's 3. So that will be good news for some. There's a bit of detail about exactly how this applies, but there's also some good news there in terms of simplification. However, the devil's in the detail, and there's quite a lot of work to sort of go through exactly how people will be able to avail themselves of this. But on the face of it, it's good news, as well as an expansion to income within sort of structures which was previously excluded.
It's just a question. There's a couple of complex questions here, so I'll try and tease out the slightly more straightforward bits. If tax has been paid overseas already, so if tax has been paid in the US on amounts overseas and that's remitted in, how does the 12% work to the income that's already been taxed?
Yeah, so under this temporary repatriation facility, anything that's remitted to the UK is going to be treated as being remitted net of any foreign tax. So what that means is that there will be no credit given for any sort of foreign tax that's been paid on that. So you would just pay the 12% on whether you remit, regardless of whether or not you've suffered tax in a foreign jurisdiction.
And then one just on the rebasing. Is the rebasing automatic and forced on individuals, or can they elect out of it if they've got losses?
Yeah, so the rebasing will be something that you could choose to do because it won't be something that's beneficial for, you know, all your assets. For example, some might have gone down, some might have gone up. So it'll be a case of looking at, you know, what the position is for each asset and then making the decision.
Okay, there's a few more, but we might wrap up on the others at the end, Joseph. Sorry, back over to you.
Yeah, no problem. So the final bit as regards to changes is on inheritance tax. So it was previously announced that inheritance tax was moving away from a domicile based regime to also be based on tax residence. And the suggestion for people who had previously you know, been outside the scope of inheritance tax because, you know, they were non-domiciled would be changing once they became resident in the UK for 10 years. So the government have confirmed that that 10-year tax residence test will be what will be introduced, but it's going to be looked at as a, you know, 10 out of 20 tax years. So once you've been resident for at least 10 years out of the previous 20 tax years, then your worldwide assets would be within the scope of UK inheritance tax. So that's quite a significant change. And quite unfortunately, there's been a sort of a line drawn in the sand by the government in terms of any overseas trusts that people might have set up. Sometimes, you know, because the rules gave preferential treatment to assets held in such trusts, the government have said that where people are long-term resident, i.e. who have been resident in the UK for more than 10 out of the previous 20 tax years, any assets held within such trusts would also be brought within the scope of UK inheritance tax. Now, there is a particular inheritance tax regime that applies to trusts, which is separate from the one that applies to individuals. But effectively, what it means is that there will be sort of a, you know, every 10 years from the sort of trust being set up, there will be an up to 6% inheritance tax charge applied to all assets within trusts that have been settled by people who have been long-term UK resident. So that is something that people are hoping would be changed by way of kind of grandfathering of existing trusts that have been set up for, in some cases, many years, but unfortunately the government have not gone down that route. However, there was something that people were expecting in terms of what we've been calling a tail, which means that after you've been within the scope of inheritance tax because you've been resident for, you know, at least 10 years, if you then subsequently left the UK, you would continue to be within the scope of inheritance tax for 10 years after you left. The government seems to have recognised that that was particularly difficult thing for people to accept, and so have introduced a sort of tapering, depending on the length of time somebody's been resident in the UK, that tail will be adjusted. So for example, if you've only been resident for 10 years, and then you leave in your 12th year, for example, the tail being you being within the scope of inheritance tax will be only 3 years. And then the longer you've been resident before you leave, then that tail increases. So there is a bit of, I guess, watering down of what was previously expected to come in, but it's still a significant change for people who have historically never had to worry about inheritance tax and their non-UK assets particularly. So that's a very unwelcome change. And people who are affected will have to be considering their position from now, really, just to understand the impact on them and on their assets. And then final point on that is, with the introduction of these changes, it's going to bring into focus the application of some particularly complicated offshore anti-avoidance rules, because the trusts that have also, you know, previously been excluded from inheritance tax will now also be brought within the scope of income tax and capital gains tax. But a lot of that is dependent on the application of particular offshore anti-avoidance rules. And the government have recognised that some of these rules are quite complex and could probably work a lot better. So there will be a consultation on sort of how aspects of those anti-avoidance rules can be simplified, just to help people to get some certainty in whether or not these rules would apply to their circumstances. So that's going to be consulted on from now, but the application of any changes will not be until the 6th of April 2026. So there'll be at least a year where there'll be people who are affected by these rules with the uncertainty that currently comes with some of them, but there's not going to be any change to them until a year after that. So that's an unwelcome delay, but there's some positive in the sense they're going to be looked at. So hopefully that can come with some simplification.
Okay, so inheritance tax. As expected, we did see some changes to the regime. So the current freeze on the inheritance tax thresholds will be extended for a further 2 years till April 2030. So the nil rate band will remain at 325,000, and the residence nil rate band will remain at 175,000 and will begin to taper away once your estate is valued at 2 million. So as we've seen in recent years, this will mean that more estates are dragged into the inheritance tax net. So early planning and making sure that your wills are properly drafted to maximise the benefit of that residence nil rate band will be more important than ever. The second point, again, something that was rumoured and we did see announced was that unused pension pots and death benefits will be brought within the scope of inheritance tax from April 2027. So this isn't new. Tax on death benefits was the case before 2015. So this change restores that treatment and does, I think, signal from the government that they want pensions to be used for retirement rather than for transfers of wealth. So as yet, we don't know a huge amount of detail on this measure in terms of how it will be implemented, but the expectation is that the spouse exemption will apply if you are leaving your pension to your spouse. And we don't also yet know how this will potentially interact with income tax charges, particularly as under current rules, if you are a beneficiary making withdrawals from a pension for someone that died over the age of 75, then you currently pay income tax at your marginal rate. So with the inheritance tax and the income tax, you could be potentially looking at an 85% tax charge before it reaches the beneficiary. So the published documents don't mention anything about this, but there is a consultation that has been opened to consider these changes, and no doubt that will be raised in that. So what this does mean is that you may need to revisit your financial and estate planning, particularly if you have quite valuable pension pots. And one of the perhaps unintended consequences of this is that the inclusion of your pension pot in your estate could well cause the value of your estate to breach that 2 million limit at which the residence nil rate band begins to taper away.
There's a couple of questions in on that, Claire, as we'd expect. So this one is sort of the $64 million questions. Inherited pensions from 2027. What are the options on preserving the IHT exemption? I mean, they're very few. The conversations I was hearing in the office yesterday was previously there'd always been a word of caution about taking your tax-free cash out because you're taking it from an IHT-free and tax-free environment into an IHT chargeable and income tax capital gains tax chargeable environment. If we now know that from April 27, the pension's within the charge to IHT, I think that changes that discussion. So you've got more flexibility on planning for that money by taking it out and possibly giving it away to the next generation. So definitely want to speak to your financial advisor about please don't do anything rash. But taking money out of the pension, you're going to have much more freedom on how you then you plan for it later. Another question came in on gifts out of income, so gifts out of surplus income. The press went wild on suggesting that was going to be abolished. It didn't even feature in the budget. So Claire, as far as I'm aware, gifts out of income absolutely fine. So people who want to plan for their inheritance tax by giving income away regularly is still perfectly valid and a very powerful form of inheritance tax planning.
Right, please, thank you. So by far, I think the most significant change we saw to the inheritance tax regime was the restriction to agricultural property relief and business property relief. So agricultural property relief obviously applies to land that's used for agricultural purposes, and business property relief to business assets where those businesses are not wholly or mainly investment companies. So from April 2026, the 100% rate of relief will continue to apply, but only for the first million of those combined qualifying assets. And thereafter, the relief will be at 50%. So that means there's an effective inheritance tax rate of 20% on values in excess of 1 million. Now, a technical consultation will be launched in early 2025, but it is expected that this 1 million allowance will apply to property in the estate at the date of death, lifetime transfers to individuals in the 7 years before death, and transfers into trusts. So again, this allowance is looking at in lifetime and on death. And it's expected that trustees will also be able to claim relief, again, up to a total of 1 million qualifying assets of agricultural and business property. And this will apply per trust for trust set up before budget day, but it is expected that from budget day, if you're setting up new trusts, then that 1 million allowance will be split between those trusts. So a huge concern, I think, this will be for many family businesses that will be passed to the next generation, because these families will now be faced with potentially funding quite a large inheritance tax bill without having the cash to pay it. That being said, the current rules, which allow you to pay inheritance tax over a 10-year period until that asset is sold, will remain in place. And so I think the ability to use that instalment facility will become quite important. However, the sting in the tail with that option is that late payment interest will be payable or would be payable on any instalments, and that from April 2025 will be at quite a high rate of 9%.
There's a question coming, Claire. The £1 million threshold, that's that per individual, or is that the value of the business?
Per individual.
Per individual, yeah. So well, if you have lots of children and share the family business around all of them.
So we are waiting on, again, like with all of these things, more details on that measure, but perhaps, you know, as a result of this change, we might see more lifetime transfers of farms, of businesses, in the hope of surviving that 7 years from transfer. So the next measure, as far as business property relief is concerned, is that there will also be a restriction for quoted shares designated as not listed. So here we're talking about AIM shares. And again, that relief will be restricted to 50%. So in other words, a 20% inheritance tax rate will apply on AIM shares. And in this case, we haven't got the £1 million threshold. And Joseph, if you can quickly flick to the next slide. And you can see here the AIM market reacted quite well to that news, because it had been rumoured that that relief potentially could be abolished altogether for AIM shares. So it did rally shortly after the announcement. And finally, on inheritance tax measures, if you can jump back, thank you. Agricultural property relief will be extended from April 2025 for environmental land management, following a consultation last year. And I think that's, yeah, over to you now, Joseph.
There's a good question here, actually, Claire, on if the inheritance tax is paid, so a business owner dies and 20% inheritance tax is paid on the value above 1 million. If the person who inherits the business, inherits the shares in the company, say, then sells that company, what would their CGT position be?
Well,
I mean, I suppose the question is, do we still get the uplift to probate value?
they should do.
Yeah,
yeah.
I mean, that would be my view too. So it's the same as now. If somebody dies and somebody their beneficiaries inherit a business, they inherit that business at probate value. At the moment, it goes to them in free of inheritance tax, and their inheritance tax is paid. But the probate value is then their capital gains tax base cost. So all we've got now is still the very generous uplift to probate value on death. That was at risk of being changed, but has remained on the statute book. But in order to get that uplift to probate value, there's now, in some cases, going to be this 20% inheritance tax paid.
Mm-hmm.
So yeah, so there was I'd say a bit of a surprise in terms of stamp duty land tax. So many people know there's been a higher rate for additional dwellings that has applied since 2016, where somebody buys a residential property but currently already owns one. So the rate's been 3% in terms of the supplement on stamp duty land tax on any sort of subsequent acquisition. But that's going up, or it's gone up to 5% from today. So the historic reason why that was introduced was to essentially free up property for first-time buyers, so that they could have more of a stock available to them to buy. So that increase is going to be unwelcome for people who are sort of acquiring second properties or more than second properties. It was a bit of a surprise. And also, there's been an increase to sort of the super rates that applies at the moment to sort of companies, or more accurately, non-natural people who are buying residential property valued at more than £500,000. So that's increasing from 15% to 17%. So, I mean, that rate applies probably in a more limited way than the sort of higher rate of additional dwellings, but it's still an unwelcome increase. That there was a sort of a manifesto pledge to increase the surcharge for non-resident people who are buying UK residential property, for that to be increased, but that wasn't in the budget yesterday, so that was a surprise. But arguably the rates are already significantly high, so it might have been thought that that was not sort of a necessary addition to SDLT, which is quite unpopular generally. But it remains to be seen whether or not they look at that a bit in future budgets. So what was also kind of not a surprise was the sort of the temporary uplifts introduced by the previous government to the thresholds for SDLT for first-time buyers. So that's going to be going back to what it was before that change from next year. So that wasn't surprising. And yeah, so that's happening. In terms of other things, so the previous government had already announced that the furnished holiday lettings regime will be abolished from April next year. So that's going ahead. Again, as expected, so no surprise there. But that will still be something that significantly changes the tax landscape for people who have previously sort of had furnished holiday lets, in terms of there going to be an increase effectively in the rates that apply to them. And there was a lot of speculation about ISAs. People were worried about an introduction of a lifetime cap to the value of ISAs, but none of that has transpired. However, the sort of subscription limits for ISAs have been maintained and will be maintained at the current levels until April 2030. So a British ISA was something that was talked about and consulted on, which was effectively going to be an additional 5,000 allowance, if you like, if you made an investment in an ISA that was geared to UK companies. So that will not be introduced now because the responses the government received to the consultation were mixed effectively. So yeah, so that's not going to happen, but I guess it was never something that people were necessarily, expecting to happen, I think, but, others might have been, but from what I was hearing, it wasn't something people thought was necessarily going to happen anyway. So not a big surprise, maybe.
We'll stop typing out answers to questions, which we're getting many, so do please keep them coming in and go for employment tax. So we're going to cover this. I'm sorry, we're going to go over our 45 minutes, and I think it was a pious hope to think we could cover the budget in 45 minutes. So please do stay with us if you're able to. Employment tax, well, let's do the big one, and this is the one that is going to raise 25 billion out of the 40 billion that the Chancellor is hoping to collect. So this is the increase in employers' national insurance. On the way into the budget, we thought it might just be employers' national insurance on employer pension contributions, but oh my goodness, much, much worse and much more far-reaching. We've got an increase in the rate, rumoured to be 2% on the day, and it ended up being 1.2%. So we're going from 13.8% to 15%. And that applies from 6th of April 2025, which just about allows us to get all the payroll systems updated for the new rates. But the real surprise, which is going to raise an awful lot of tax, is the dropping of the threshold from £9,100 to £5,000. Now, what that means is currently it's only once you start paying an employee more than £9,100 that an employer would incur the 13.8% currently employer's national insurance liability. By dropping that to £5,000, it's the employer's national insurance charge is going to come in much, much sooner. And just to do the numbers, the difference between £9,100 and £5,000 or £4,100, if you charge that to the 15% rate that's going to apply, every single employee that you employ, if you're a business owner on this call, is going to cost you an extra £615. And that's only on their earnings up to £9,100. On their earnings above that, they're going to cost you an extra 1.2%. So that means if we look at average earnings in the UK, it's about £35,000 at the moment. The increase is £926 per annum per employee. So as you can imagine, business owners around the country are doing their arithmetic to work out what this is going to cost them. All of the OBR numbers on this expect employers merely to build this into wage inflation so that pay rises will slow down. So this measure is expected to collect a lot in the first couple of years, and then employers will just start holding back on pay rises, and it will just be absorbed into the overall tax charge. So it's a big earner in a couple of years. It tails off very quickly. We've got the employment allowance, which allows employers to deduct £5,000, currently £5,000 from their employer's national insurance liability, and that was limited to employers with only £100,000 of liability. That £100,000 cap has been removed, so now everybody gets the employment allowance, and it's going up to £10,500. So there's an extra amount to deduct. But if you think the average employee is going to cost you about an extra £925 per year, really, this is only covering you for an additional 5 or 6 employees. So, to businesses that are big employers, if we talk about the service sector, whether that's hospitality and leisure or whether it's professional firms even, they are going to bear the brunt of this, and there will be a shift towards looking again at self-employed labour and dealing with all the complexity of IR35 and related regimes. And there'll also be a look to moving jobs outside of the UK. So this is, I think, quite a strange move by government to take such a large amount from employers. I think they're doing it because as a country, we are close to full employment at the moment. The unemployment rate is very low. And therefore, if this ends up increasing the unemployment, it's not actually too much of a worry right now, but I imagine government will keep their eye on it. It feels a bit like the pasty tax. Those who remember when they tried to introduce VAT on hot pasties, and there was a rebellion sufficient to mean the policy never saw the light of day. This feels so harsh to employers that I wonder whether between now and the 5th of April 2025 there'll be some sort of watering down of this. Joseph, next slide, please. Claire, if you can just keep an eye on the questions. So EOTs, there was a question that came in on EOTs. Now, we'd had a consultation on EOTs a little while ago just to tighten up some of the rules. So no longer can, so EOTs are employee ownership trusts, are a structure that allows business owners to sell their business to a trust entirely free of capital gains tax, and the business is then held for the benefit of their employees. EOTs are very popular right now, but will become even more popular because the CGT exemption on selling the business looks even more attractive now that business asset disposal relief tax rates are going up and the headline rate of tax is going up. The changes to the EOT regime are not really surprising. They were all announced already, bar one. So this is not allowing former shareholders to have influential or controlling positions on the trust. We can't put the employee ownership trust offshore anymore, and that was very much in the minority anyway. There's various technical changes that mean that the flow of funds around EOTs to pay off the vendors now, there's greater certainty on the tax treatment of those from HMRC. The two changes which I think are probably just need a bit more thought is around the period of time in which the CGT exemption can be lost. It used to just be 1 tax year following the year in which the EOT was implemented. That's now going to be extended to 4 years. So there's a bigger danger window in which if the EOT fails a condition for some reason, the original shareholders could lose their tax relief. So that needs a bit of thought, but should be manageable. And then an extra condition in order to secure the tax exemption for sale to an EOT, the vendors must take reasonable steps to ensure that the price they're receiving is market value. Now, all EOTs are supposed to take place at market value. It's now a statutory condition that they've taken reasonable steps, which means you've employed a valuations expert to do a proper valuation rather than had a vague guess at what the value might be. So, valuations in EOTs must be done with even greater care than before. But again, that was largely under control as far as I could see on the ones we'd worked on. I know, Claire, have any questions coming on EOTs? I know they're of interest.
Yes, on EOTs, if your EOT is already offshore, is that still okay?
That is a very good question. I suspect you'll be given a time period to bring it back in the UK, but I haven't gone into the draft legislation. Well, that's a good question, so I'll follow up on that one separately. I will. It's relevant to a few of our clients, so I will answer that one for sure.
That's it on EOTs.
Okay. Joseph, next one on employment tax matters. So national minimum wage, I mean, that's going up. The increase to £12.21 an hour, which is the rate that most people are focusing on, is a nearly 7% increase in the rate. Again, if you look at sectors like hospitality who are suffering from the extra employers, and typically have people at the lower end of the earning spectrum, so the increase in national minimum wage, this is a big strain on the hospitality sector. So do expect, as you pay for your next meal in the restaurant, that the price is going to go up, because these costs are passed on to the consumer where the consumer can afford them. Next one, Joseph. Yeah, and then a couple of things as we're tired sometimes. And mandatory payrolling of benefits, the end of P11Ds is still coming in April 2026, and there's a bit of anti-avoidance coming in, or HMRC are fed up. Sorry, hopefully the audio is still there. HMRC are fed up with offshore umbrella companies disappearing without paying their tax. So they're moving the burden of who needs to pay the PAYE when an umbrella company is used to recruitment agencies, or if there's no recruitment agency involved, to the actual business using the umbrella company. So if in your supply chains you do have umbrella companies who provide you with labour, just be careful that the liability for PAYE, if it all goes wrong, might land somewhere where you're not expecting. And then I think we're pretty much on the home straight. I'm going to hand over to Nick on corporate and business tax.
Yeah, thanks, Tim. And I'm conscious of time, but while the Chancellor went to town on a whole host of other taxes, as we've heard, there was barely a mention of corporation tax at all in terms of hard measures and hard announcements in yesterday's budget. What was published instead by the government was a corporate tax roadmap in terms of how it sees the landscape of corporation tax over the course of this Parliament. So I just thought I'd go through some of those measures, which effectively are an endorsement of the current structure of corporation tax and the current rates of corporation tax. So these are the main measures that they're expecting to keep through the rest of this Parliament. Corporation tax is going to be capped at the main rate as it is at the moment of 25%, and indeed they're legislating now for that to be fixed through to March 2027. The small profits rate of 19%, which is for profits under £50,000, and the marginal relief, which is for profits between 50,000 and 250,000, will all be retained. So that the structure of rates is expected to be kept at their current levels. On capital allowances, similarly, the full expensing regime that was introduced in the last few years and the £1 million annual investment allowance, as well as the other main features of the capital allowance regime, are expected to be maintained in the way that they are at the moment, as are R&D reliefs. There's been a lot of change in R&D over the course of the last few years, but the government is broadly expecting to keep the regime as it is now settled down to. It is expected to continue to develop the way in which it administers it and it monitors it in the way that it has done in the past few years as well. Other features of the corporate tax regime, things like patent box, intangible fixed assets, are expected to be retained as well. There is expected to be some changes on transfer pricing, which is the way in which companies within the same group charge each other for services, and ensuring that these things are done at an arm's length basis. There is a potential widening of that scope. Currently, SMEs, so that's broadly businesses with less than 250 employees, are outside of the transfer pricing regime, but they're expecting to remove that exemption to only just the smallest businesses. So it's quite possible that a lot of SMEs are going to be brought within the transfer pricing regime. And the government also announced continuing commitment to what's called the Pillar 2 legislation, but it's essentially the global minimum tax of 15%, and will continue to work with the OECD on that sort of move on global taxation. On business rates, the government has announced that it's committed to a full reform of business rates and how they work. It hasn't published anything in detail at the moment, but it has made a couple of interim measures. So for those in the retail, hospitality and leisure sector, there is going to be a 40% business rate relief up to a cap of £110,000 per business per year. And that's really until they come out with a full proper reform of it. And the business rates are essentially worked out through looking at a multiplier, which is applied to the rateable value of the business, and is expected that on an ongoing basis there will be a permanent reduced multiplier for those the businesses that operate in the retail, hospitality and leisure sector. They did announce the small business multiplier, which effectively gives small businesses smaller levels of rates that will be frozen, but the standard multiplier, which applies to bigger businesses, bigger premises, will be increased in line with CPI. Just touching on some other measures, those in the oil and gas sector who are affected by the energy profits levy, that is going to increase from 35% to 38%, and extend for a further year through to 2030, which is when we're expecting the sunset clause to finish on that. That means that those that create profits in that sector are now paying corporation tax effectively at a rate of 78%, because that 38% is on top of an existing rate of 40% that applies to those businesses. So it's a very high rate of tax for those businesses. The way in which charities are taxed is currently going through reform, and no major announcements yesterday, but just essentially continuing consultation on that, with an expectation that there'll be new legislation in place for April 26 in respect of how charities are taxed. And there was an increase in the rate of the audio-visual expenditure credit, which is essentially a credit for those who operate in the film and high-end TV rate, from 34% to 39%. That brings it in line with those who operate in the animated and children's TV sector. And just moving on, Joseph, because there was so little on corporation tax, I'll cover the indirect tax measures as well, or at least some of them. No major changes on private schools. Well, no major changes to that which has already been announced, which is effectively that from the 1st of January, in just a couple of months' time, there will be a VAT applied to private school fees, and that from April 2025, the business rate relief for those schools will also be removed. The soft drink industry levy, which is colloquially known as the sugar tax, that's going to increase by more than inflation over the next few years, to take account of the fact that it hasn't taken account of inflation over the last few years. For those flying long haul, there's going to be a big increase in air passenger duty. I think this was Rachel Reeves' one joke of the day yesterday around Rishi Sunak's travel arrangements to California. There's going to be a big increase, 50% for APD on large private jets. And there's light going for me again. Fuel duty rates will be frozen. So this is the announcement that yesterday that took some people by surprise, that the fuel duty will continue to be frozen through until March 2026. A vehicle excise duty, again, as you might expect, for gas guzzlers, that's going up in order to pay for frozen duty rates for electric vehicles. So continuing encouragement for people to take electric vehicles rather than bigger gas guzzlers. And that's it.
Now, as we're at 11 o'clock, which is 15 minutes over, if Joseph, you can just skip on one slide, because there's only one thing from admin and HMRC powers that I think I really want to cover, which Claire's mentioned already, which is just bear in mind that the interest rate on late payment of tax is going up to 9%. So that's going to be the Bank of England base rate plus 4%, I think is where we've landed. And that's from 6th of April next year. That if you are slow or unable to pay your taxes, for example, you might have inheritance tax to pay, but you've got an estate stuck in probate. You know, there are lots of reasons why people don't and can't pay their taxes. This late payment interest is going to become extremely expensive at these rates. So it's a big money earner. Just click on one more, Joseph, in case there's any other sort of absolutely, yeah. So, and then one more. Yeah, so the slides will be sent round. I'm sorry to skip through the end so quickly, but we ran over a little bit. Thank you very much for your questions. We've answered all bar a very small handful, which we'll do as follow-up from this. It just remains me to thank the panel and thank you for such a large number of attendees. I think it might even be in record-breaking mode for the number of attendees to this. So very, very pleased that so many were able to join us this morning. As you can imagine, some of these subjects deserve a much deeper dive. So keep an eye on our seminar program. We will be doing separate deeper dives into inheritance tax planning, non-domicile tax planning, and other things as and when the extra material becomes available. Thank you very much.